Investment Property IAS 40. Investment property is property, land or buildings, held by the owner or by the lessee as a right-of-use asset, to earn rentals or for capital appreciation or both. Following are not investment property. Property held for use in the production or supply of goods or services or for administrative purposes, IAS 16 property, plant and equipment applies. Property held for sale in the ordinary course of business or in the process of construction of development for such sale, IAS 2 inventories applies. Property being constructed or developed on behalf of third parties, IFRS 15 revenue from contracts with customers applies. Owner-occupied property, IAS 16 applies. Property that is being constructed or developed for use as an investment property, IAS 16 currently applies until the property is ready for use, at which time IAS 40 starts to apply. Property leased to another entity under a finance lease, IFRS 16 leases applies. Recognition. Investment property is initially recognized at cost. Measurement. Subsequent measurement. Cost model. CV equals cost less accumulated depreciation and impairment loss. No revaluation permitted. Revaluation model. CV equals fair value. Rules. Fair valuation to be done each year. No depreciation is charged. All gains and losses on revaluation are charged to PL. Transfers. Transfer from investment property to owner-occupied property. Use the fair value at the date of the change for subsequent accounting under IAS 16. Transfer from investment property to inventory. Use the fair value at the date of the change for subsequent accounting under IAS 2 inventories. Transfer from owner-occupied property to investment property to be carried at fair value. Normal accounting under IAS 16, cost less depreciation, will have been applied up to the date of the change. On adopting fair value, there is normally an increase in value. This is recognized as other comprehensive income and credited to the revaluation surplus in equity in accordance with IAS 16. If the fair valuation causes a decrease in value, then it should be charged to profits. Transfer from inventories to investment property to be carried at fair value. Any change in the carrying amount caused by the transfer should be recognized in profit or loss. Disclosures. Whether cost or FV model is used. Amount recognized in PL for the period. A reconciliation between the carrying amounts of investment property at the beginning and end of the period. The fair value of investment property if the entity uses the cost model. Example 1. Lavender owns a property, which it rents out to some of its employees. The property was purchased for $30 million on January 1, 2022 and had a useful life of 30 years at that date. On January 1, 2027 it had a market value of $50 million and its remaining useful life remained unchanged. Management wished to measure properties at fair value where this is allowed by accounting standards. Before the revaluation, the building had a carrying amount of $25 million, $30 million multiplied by 25 divided by 30. The building would have been revalued to $50 million on January 1, 2027, with a gain of $25 million, $50 million minus $25 million, recognized in other comprehensive income. The building would then be depreciated over its remaining useful life of 25 years, 30 minus 5, giving a depreciation charge of $2 million, $50 million divided by 25, in the year ended December 31, 2027. The carrying amount of the asset as at December 31, 20 times 7 is $48 million, $50 million minus $2 million. Example 2. ABC owns a building that it used as its head office. On January 1, 2021, the building, which was measured under the cost model, had a carrying amount of $500,000. On this date, when the fair value of the building was $600,000, ABC vacated the premises. However, the directors decided to keep the building in order to rent it out to tenants and to potentially benefit from increases in property prices. ABC measures investment properties at fair value. On December 31, 2021, the property has a fair value of $625,000. the building must be revalued from $500,000 to $600,000 under IAS 16. This means that the gain of $100,000, $600,000 minus $500,000, will be recorded in other comprehensive income and held in a revaluation reserve within equity. Investment properties measured at fair value must be revalued each year end, with the gain or loss recorded in profit or loss. At year end, the building will therefore be revalued to $625,000 with a gain of $25,000, $625,000 minus $600,000, recorded in profit or loss. Investment properties held at fair value are not depreciated.